Welcome, everybody, and thank you for joining our webinar today, All the Pieces Matter, a guide for emerging fund managers in South Africa. We know that this is about a bit of a mouthful, but we are very excited to have you here today and to share some of our experiences as a fund investor, focusing specifically on elements that can help emerging fund managers flourish. With that being said, our webinar today draws primarily from 27Th's Thought Leadership series with the same title, All the Pieces Matter. With a focus on our most recent report, which stems from our experience assessing over 30 applications from emerging fund managers at the start of this year on the back of the launch of our Funder Forward program in December. For those of you who don't know much about Funder Forward, it is an initiative where we are very proud and fortunate to be partnering with a USAID mobilizing investment to facilitate dedicated support to women-led fund managers in Southern Africa. If any of you would like to hear more about this program, please feel free to reach out to any of us so that we can share more about this impactful work that we are doing. But I digress. Although today we will focus on our observations from this program, we also wanted to integrate some other observations from other 27 thought leadership pieces published to deepen the discussion and understanding today. But before we jump into it, I wanted to take a moment to share with you some information about how the proceedings will be run. Links to All the Pieces Matter featured in today's webinar will be posted in the chat for ease of reference. We do encourage you to click through those, take some time and read them. We really have spent a lot of time and put a lot of thought into what we've been publishing, addressing specifically and responding to some of the concerns that not only investors have, but also fund managers are dealing with as they raise capital and manage their funds. And although we acknowledge that the participants will be muted for the duration of this webinar, for reasons of Q&A, we ask that you use the function available in Zoom specifically focused on Q&A that will enable us to see the questions that you post, and we will attempt to answer this before the end of the session. There will also be a formal Q&A session before the end of the webinar, so that if you had any specific questions that you wanted to reserve for then, we please also ask that you use the Q&A function available to you on Zoom for us to facilitate responses to any queries or questions you might have. We also wanted to make today a bit more insightful and interesting, and therefore we've decided to launch a few polls as we will be having our discussion today throughout the course of the webinar. And as we know, every vote counts, very topical in the context of the US elections more recently. We ask that you really do put some thought into it and please respond to these Q&As, to these polls. And these will be answered in a session that we will have just before we get into the formal Q&A session at the end of the webinar. Mix, if I can maybe ask you just to launch the first of these to get everybody participating and going. CPD points, we know that this is almost just as important as the content that we are presenting today. So for all attendees staying the full length of time of the webinar, we do confirm that CPD certificates will be automatically generated 2 to 3 weeks after the session. With that being said, I think I can say convincingly that most of us today are not only here for the CPD points, but because we have a shared belief, right? That belief being that the Southern African private equity landscape is dynamic, ripe with growth and opportunities. Interest in impact investing and diversity is rising and attracting global investors to African markets, presenting a significant opportunity, despite what some have perceived as a reluctance from those investors to take the risk. Perceived or otherwise, although we acknowledge that investment doesn't come without risk, the 27-4, we've experienced that this perceived element of the narrative is one that can and should be more actively challenged in most instances through the positioning and behavior of fund managers. But how does one do this, you may ask? Well, to share some of perspectives with you, I'm joined today by Rory Ord, Head of Private Markets at 27-4, and Chad Potter, Principal in the 27-4 Private Markets team. And with the formalities out of the way, I would ask Rory to start the conversation.
Thank you, Morde, and morning to everyone. Great to see so many of you joining us on the webinar today to talk about some of our favorite topics. I wanted to start the conversation today with something that you know, for a lot of the newer fund managers that we work with, is something that's sometimes uncomfortable early on in their journeys. But it's the realization that as a fund manager, doing the deals and focusing on the deals is not the only part of what running a fund is about. That's not to say we don't like the deals. We love the deals, and you know, most people who come into the private market space do it because of the kind of the love of the deal and working with private companies. But it's only part of the story. It's definitely not the only thing. And we would go as far as to say that, you know, working within the fund construct that you have and managing that full picture is actually a big part of what is done, and is a big part of what ultimately drives the right outcomes.
Yeah, I absolutely agree, Rory. So it's important for an emerging manager to know that if they are to be successful, they need to be seeing things from the investor perspective, right? And we can confirm this. We know that it's not just about the deal hustle. They want to see the whole movie, so to speak, and not just the credits, right? So we can't emphasize this enough, right? We have to convince the investor ultimately. And for you to be able to do so, you can't underestimate what is required. A grasp of fund management operations, and yes, that includes elements like HR, which all of us hate to deal with, alongside things like fund strategy, portfolio construction, risk management, are all elements that really need to be there, right? And if you don't have all of those elements present, then good luck. You're going to really, really be struggling to find a footing and advance conversations with investors. But when we do this, it ultimately comes down to different perspectives, right? So, and perspectives between the investor and the fund manager that need some type of reconciliation. So, Mix, if I can ask you to maybe launch our next poll where we explore these perceptions of what you think investors need to be prioritizing.
Yeah, but you know, it's strange when we work with these emerging managers. I think some of them don't realize how crucial the fund strategy is until they're in the thick of it. With the Funded Forward program, for that matter, I think we've seen through a number of engagements during assessing various managers for that program, just how great they are at deal execution, but I guess translating that into a bigger fund strategy and overlaying fund manager operations, that's an entirely different ballgame, entirely different story for them. It's, I think, a common pitfall of some emerging managers, where they focus on those individual deals over the overall strategy, and they forget what's required in terms of operational capacity support on that to support the execution of that strategy for fund construction.
Yeah, and you know, this idea of diversification is really a key focus for us as investors and for other investors that we come alongside as LPs into emerging funds. You know, as much as we love that sort of big winning deal, what's much more important to us is replicability and kind of repeating and having proper diversification in a portfolio to stabilize returns, you know, lower the volatility, and keep that portfolio construction resilient. So, you know, we want that kind of protection from building a portfolio in that way. And it's really what makes a private equity investable as an asset class, to have that predictability, that understanding of what return you can get, and kind of making sure that those returns come through consistently. And then, but of course, you know, that's only part of the picture, especially when DFIs are in the mix.
Yeah, exactly, Rory. You know, when DFIs are added to the mix, what you need is this additional layer that they're asking for impact through thematic focus, right? So things like climate, gender, tech inclusion. But now you sit with the problem that you need to balance diversification with this need for specialization. And as if, you know, your work wasn't already cut out for you and hard enough, you know, you have to kind of do this, right? It's a non-negotiable. So unfortunately, although we sympathize, I think the reality is that investors will not cut you any slack, right? They want it all. They want that real focus while also looking at diversification benefits. And yes, we do acknowledge that that might be a tightrope to walk, but it is what it is.
Yeah, it's so true, Made. I think it's important that I guess when you go deep on a specific theme for your fund, you're building up specialized expertise. Say if you're focused on gender, you're not just doing deals, you're crafting a portfolio that's aligned with those impact goals in mind. But I think over diversifying or structuring to try and meet every investor's requirements can actually dilute your specialization and authenticity in execution of that strategy. Yeah, it's not just about having a little of everything. It's about depth within that theme and being able to actually, I guess, focus and deliberately focus and be intentional around that. I think, Mix, if you can put up the next poll for the audience, that'll be great. Thanks.
Yeah, so I think this issue of complexity that Chad has brought up is a really important one to spend some time off, right? So the reality is too much complexity makes it look like your strategy is scattered, right? Even though you might argue that it is technically diversified. So ultimately, investors might think that you are trying to do too much, right? Which then they perceive as a risk, right? So once again, how do you win? I think you can safely say that for any investor, though, quality diversification beats a laundry list every time, right? Like they do truly look into it, they truly value the benefits of proper diversification. But it's difficult to do this, right? And this is a point we acknowledge often in a thematic fund, right? So what we would argue is that it's about the depth of kind of the focus in that one area. And an example of that would be, how do you diversify within a focus that or a strategy that focuses on one sector? It's about going into the subsectors within that sectors and the sub-themes within that sector and building out a strategy where you can, confidently face an investor with, a compelling reason and compelling data points that show that you are diversifying, although you are remaining kind of strategic and thematic within your fund strategy. But doing this without becoming too narrow is also what you need to balance, right? You can't be too narrow to the point of frigidity.
Yeah, absolutely. I mean, so we as investors, we understand that this balance is key, which is why, why investors in the market are willing to support a focused approach, so some narrowing of investment thesis, but it must still allow for the right level of diversification around it. So they're looking for that idea, that sort of beautiful Goldilocks area of specialization, but with sufficient opportunity in it. And then, of course, within a robust risk framework. So it must be an area of focus that can kind of withstand the risks that are likely to come to it. And of course, the challenge of doing this whole thing is putting this all together without actually introducing more complexity, doing it in a way that's kind of clear so that, you can market it well, and clear so that it's clear what your mandate is when it comes to actually making those investment calls, going through your investment committees, and reporting back to your investors in the end that you've actually invested, according to the strategy and the theme that they were expecting, and so that they can get the outcomes that they were anticipating.
Yeah, Rory, yeah, thank you. We've seen in most cases when we have engagements with emerging managers that I guess they think if they add more complexity, the investors will be more impressed with what they're putting out there into the market. But actually, what we've found is simplicity can be more appealing. I think, focusing more on the actual strategy, not so much on sort of the legal twists or elaborate structures that can really confuse investors, I think is key. In what we've also noticed, especially with emerging managers, where I think where funding constraints is real during that early fundraising stage, and getting to a first close, it's also important to sort of maybe keep things, I guess, a bit more simple, rather than overly complicating things and getting started on those legals and elaborate structures. That all becomes and all can get quite messy and costly at the end of the day.
Yeah, that's right. So that, we always say less is more, and that's especially true in the early days, when you're trying to get started. and you're in that awkward space of, doing fundraising, trying to develop a deal pipeline, kind of evolving things on the fly a little bit, and all the while, having to effectively survive as a team, particularly, when you're in that period pre-earning fees. So this touches on, the idea of working capital. How do you survive as a fund manager, during that time prior to actually having meeting the first close of the fund? So, that access to working capital actually underpins any fundraise, that ability to actually sustain that period, which can be very long. Anyone who's raised a fund or been involved in fund management knows that, particularly for first funds, I mean, it can be a very, very long process. And, what it means is that the managers who have come together, the individuals who have come together to form the team, are spending their savings. They're living off whatever they have, or the support of friends and family during that time, or running other advisory mandates to keep the lights on. They're doing something to kind of keep them going through that time. So, this idea of complexity that we've been talking about and keeping things simple is actually a way to help to shorten that execution period and to manage the cash burn, because the simpler things are, the clearer things are, and that's one way of keeping things as short as possible during that fundraise period. So sure, so when, one of the things that we often speak with our fund managers about is the deployment cycle, and that definitely should be one of the key areas that fund managers are focusing on. But it is, of course, a balance. It may mean that to accelerate deployment, more team members are needed, but that, of course, comes with greater drain on the team's resources. So, we understand this is a balance, especially in the early days. But we want to see that managers are actively working on that and are considering the different elements appropriately and coming up with the right solution, or talking with us about it, so that we can help where possible, or help the manager to come to the right position. Because ultimately, sustainability during this period is really important. There's a reality to actually paying people and keeping the lights on. And if you kind of run ahead of yourself, then the structure becomes unsustainable. Then it's not just going to hold up.
Yeah, you're right, Rory. I think doing things sustainably, though, with the least complexity, I think doesn't mean that it's a one-man or one-woman show is the way to go either, to keep costs lean during that fundraising phase. I guess we've seen managers who are individually excellent, which on the one hand may be impressive, but it's also nothing that an institutional investor is willing to back, and purely because of the risk associated with having, I guess, a key person risk associated with that particular fund strategy. A strong team is something that is everything, and it's something that we focus on when we look at potential managers to consider allocations to. But it's also not only a strong team, but the team's ability to communicate why each person makes that forms part of that team, and what they bring to that team is important. So showcasing that individual person's strengths, why this brings the team together, why it makes the team unique, and why the individual attributes are important and valuable in sort of delivering on that fund strategy, I think gives every investor peace of mind.
Yeah, showcasing that every person on the team brings something unique, I think, is something that we cannot emphasize enough, right? It really creates this perception of value, right, in the mind of the investor, and it does give them peace of mind, right? So it effectively adds to your ability, it builds your narrative around your track record and your experience, even when for some emerging managers, that track record and experience has been with other institutions. So, it really is something that fund managers need to face up to. And there's this idea of the circle of competence, right? That we really like and you know, is always in the back of our heads when kind of we assessing fund managers, right? And what does that entail? So the circle of competence effectively, firstly, is that when you are talking about your track record, when you are talking about your expertise to an investor, what we would suggest is that yes, there needs to be a focus on your area of expertise, and definitely one should speak to this with confidence. But one should also be able to articulate, you know, what you know, and more importantly, what you don't know, right? And this is extremely important, you know. When most investors come to you, they try and kind of convince you that, or most fund managers come to you, they try and convince investors that they're perfect, right? They've got all this competence, but we all know that we're all human, right? And therefore, the reality is that as an investor sitting, listening to somebody talking about their experience and track record, you actually do want them to acknowledge that there are aspects that they don't know, right? And you don't want them to avoid these unfamiliar areas and topics that they don't know. It is far better to be listening to a pitch where, you know, somebody has the ability to acknowledge those gap areas and demonstrate how the processes or your specific fund strategy actually spread to your strengths, and how you effectively are delegating your weaknesses, or how you're expanding on dealing with your weaknesses through a circle of learning, right? That really becomes fundamentally important. And if you can't land that narrative with an investor, if you can't acknowledge that there are lessons that you've learned and that there are gaps, then, you know, effectively you're not building your track record narrative appropriately.
Yeah, Mada, you're totally right there. I think that's so important. And I mentioned authenticity at the start. I think that's where storytelling comes in, right? It's not just about, here's the team, this is our strategy, and this is the pipeline that we're going to execute on for that strategy. It's about, this is the journey that we've been on. This is why we've formed together as a team, why we've chosen this strategy, and why it suits our capabilities. Here's what we've been through as a team, the lessons we've learned, and here's why we're better for it, and here's how we are effectively going to mitigate for some of the risks we see within some of the areas of weakness we have with it as a team. You know, we've seen how good and effective, I guess, a good narrative can be in setting the rules by which investors evaluate sort of teams, emerging managers out there.
Yeah, you're definitely right, Chad. I think fundraising isn't just about dollars and cents, right? Most think that it is just about dollars and cents. And we've mentioned that it's also about showing commitment to operational excellence, transparency, and a well thought out investment proposition. But I think what you need to be able to do is tell the story around that and acknowledge the fact that you are operating within an extremely crowded environment, right? And the only way to highlight your differentiation relative to your competitors is to know how to tell your story well.
Yeah. I think you mentioned rands and cents. I think the problem is, though, that sometimes I think even rands and cents don't add up, especially in some of the emerging managers we've considered or reviewed over the time for both the Black Business Growth Fund and also for Fund of Forward, for that matter. I think, which takes us into a discussion probably about the most topical of issues that we constantly discuss between the three of us, contrary to market opinion, but rooted in a frustrated experience.
Yeah, I think I always say this hand in hair, so to speak. We can't ignore this topic, right? And the topic is that of accurate, or should we rather say inaccurate, financial modeling. And there simply is just no excuse, right? It has to be bulletproof, and emerging managers need to understand that. Why? Because you can be sure that investors will be taking a gun to it, so to speak, right? There is just absolutely no room for funny maths or cloudy numbers within your financial modeling. Investors aren't going to stick around if your projections on your own fund, on your own operations are inaccurate and overblown, right? It is tantamount to them having some confidence in how you are modeling out your other investments that you are actually investing on a discretionary mandate basis, right? So if you are presenting to them these inaccurate, overblown numbers, then it means that you are missing some key risks, and they can't trust that what you're representing to them is therefore accurate.
Yeah, I mean, 100% agree with what Chad and Mate are saying. I mean, you're trying to convince investors that you can model businesses well, understand them well, project well. And I mean, that applies equally to the investments that you do as a team, but also to the understanding of your own fund management business. So, you know, I think in general, the modeling of fund managers' own businesses is something that I would call a big weakness in the market. We find that for some reason, you know, managers who can otherwise model a business, can understand the key risks and project for a business, struggle to put together that same modeling for their own businesses and their own, that make those numbers clear and set them out well for their own businesses, and then for the funds as well. And you know, so this is quite a big area of frustration for us, but also one where we often assist on. So, you know, managers often ask us for help in these areas to how they should think about you know, preparing their fund models better, preparing their manager forecast better, you know, what kind of expenses need to be incurred, exactly where those expenses are going to lie between a fund and a manager, exactly, where they should be taken into account and how they should think about the different things, and kind of making sure that they have all of the kind of categories of expense and how these might escalate over time. All of these are really important things for a fund manager to demonstrate that it understands its own business and how it works. You know, so it does go deeper than just the numbers. It's that kind of fundamental understanding of the business. And, you know, then it starts to translate, when you think about the metrics that this derives, it starts to translate into probably the thing that we spend a lot of time as a team discussing, which is gross to net IRR. So, you know, when managers can explain exactly how this works in their construct, so, you know, no matter what their theme or their investment strategy is, their pace of investing, the way that they derive deals, and the way that they work as a fund manager, how you know, why the specific levels of gross return are going to be there, and then how those convert through all of the actual mechanisms that exist in the fund construct, how those convert into a net IRR. When managers can really demonstrate this understanding, then it gives us a lot of confidence. When they can really talk to it with confidence, then we get confidence that they actually know their own business.
Yeah, it's like Rory says, right? It is something that we discuss a lot at 27-4, and I think it's warrants us zooming into the topic quite a bit, right? Because it is something that trips up emerging managers specifically quite often. This, what we sometimes term the elusive gross to net IRR. So it's important to understand it. So, you know, first I wanted to delve a bit into some of the technicalities around this, right? So what is the gross to net IRR? Effectively, this is the metric that measures how efficiently you are converting your gross returns from investments. So effectively, what your strategy promises to invest in and the returns that you'll be generating from that, what most managers obsess about, into the net return for investors, which is a completely different thing, right? Those are the returns that the investor actually gets at the end of the day, right? After taking into account a significant amount of costs that are sometimes ignored because relative to investment amounts, they seem small. But, you know, if you look at the bigger scheme of things, they actually have a significant amount of impact on the bottom line returns that the investors are actually getting from your investment, from supporting your investment. So understanding this concept is really paramount to demonstrating, you know, not only financial acumen, but alignment with investor interest, right? Acknowledging that this is their bottom line. The gross IRR is not their bottom line. The net IRR is in fact their bottom line. And the bottom line that we need to emphasize is that the difference between gross and net IRRs can be significant, right? And we've seen this play out. We manage a number of funds, not just within 27/4, but within the history of our exposures as individuals within this industry. And we've seen just this play out so much. The lack of understanding, but also the lack of focus on it, right? Managing those costs, and the costs specifically that cause the significant drag. And what are those costs, right? So those costs are things like management fees, organizational and operational expenses. So, lawyers, fund managers, or fund administrators, IC members, due diligence, all those things actually cost money, right? And the result effectively is value leakage to an investor. And that cannot be ignored by any fund manager trying to proposition, any investor. So these costs specifically can erode gross returns. And we need to consider those within the context of Southern Africa as well. We're experiencing a low growth environment more generally. So that means that the impact of this drag on net returns are even more evident in the outcomes of the fund performance, right? The other aspect that I wanted to touch on is the fact that although all of these things are true and you are measured over the life of your fund, I think it is extremely important to acknowledge that the impact of these costs in the early stages of a fund life is even more significant in terms of a drag on net returns, right? And it's really notable when you start reporting on it. And, investors need to understand that net returns that they can realistically expect. And when in the first few periods of measurement, these returns all are negative, significant amounts, and sometimes not even meaningful to measure, I think that really influences, at least even at the start, the perception that some of these investors have around the asset class that is private markets, but more generally, how you then claw back from that position over a period of time, right? So these are some of the things that we need to acknowledge in terms of the perspectives from, investors' side versus that of the fund manager. But these are all the things that really make capital raising and capital and management really, really difficult, right? And maybe that's one of the things that we wanted to explore in our next poll. So Mix, if you can please go live with the next question. Thank you.
Made, maybe just to add to what you said there, actually, I think, one of the things I've noticed, especially around some of the managers that we've seen in the market, is that that gross to net IRR model is a big focus during due diligence. But I think, and I'll actually ask if there are managers on the call now, I'd actually be interested to sort of hear what their views on this is. But I'll be surprised if any of them actually assess that gross to net IRR model on a quarterly, annual basis, for that matter, to actually see if they are tracking against what they initially put out there for investors from a gross to net perspective, in terms of their deployment, in terms of managing those costs. And seeing that I guess that gap between gross to net is over the course of the fund life being maintained to the level that they set out initially when they were started fundraising. I think another sort of critical element really is also the structure of commercial terms, particularly management fees and carried interest. I think that has a huge impact, I guess, on gross to net, but also how the dreaded J curve and how deep that can be at the early stages of a fund's life. Although the traditional 2 and 20 is still, I guess, very popular and prevalent in this market, it's come under scrutiny for potentially misaligning managers and investor incentives, especially where the J curve is so deep at the early stages because of slow deployment, or where the funds are at scale. And I guess the perception is that the fund managers are profiting off the management fees early on, regardless of what that performance looks like over the life of the fund. It's unfortunate, and I don't think something that managers in private markets really appreciate. But you can't escape the fact that investors, and particularly pension funds, when they look at performance on periodically and typically on a quarterly basis, and they compare the performance of the fund, and typically for most private equity funds, that's just usually underperformance against the benchmark or your hurdle that you're sort of supposed to be tracking to as at a minimum. And managers, I think, don't necessarily realize that that's what they get judged on, and they need to actually work on that work on ways to improve that, or narrow that gap over in the initial stages of the fund.
Yeah, I think that's exactly it, Chad. It's that there is a bit of a gap in understanding around how managers are measured, and particularly when you've got DC pension fund investors who are very benchmark cognizant. They are always looking. They're looking all the time, and they're saying, what is the performance over the past year? What is the performance over the last 2 years? Not only since inception and wait, 10 years down the line till the end of the fund and then judge the manager. They have to make other assessments through the life of their allocations, such as whether to make new allocations, whether to re-up to the same manager, and their experience of how consistent and repeatable and well managed the investment is, and how well the manager actually manages to these costs and things that Chad and Made have been speaking about. That really does come into that conversation, because it's a smoother ride if it's managed well. So, all of this said, we have seen some innovative ways to address some of these issues. And we'll talk about some of them. So one approach, is to reduce or defer management fees. So this is something that's, obviously very close to the heart of every manager, because it's their lifeblood. The management fee allows them to hire a team and have sustainability. But I think what the traditional model, the 2% management fee on the basis of a commitment does is it's effectively a flat rand fee. So it's a depreciating real level of fees. And so it actually doesn't fit very well. It doesn't fit very well with the cost profile of fund managers, which tend to hire teams, which then escalate salaries over time. So we've seen a number of managers in the market. We've had lots of conversations with different managers about using different ways to sculpt fees and kind of using different kind of fee mechanisms to kind of better suit their actual operations. And then using strategies like fund facilities to cover some costs, using those sculpted or stepped fees, and then wherever possible, using offsets from portfolio companies. So getting portfolio companies to pay some of the costs of deals or other types of costs. These things can significantly reduce the drag of costs in a fund structure, and have a really good outcome on the net returns of the fund. In all of this, you would notice that we haven't talked anywhere here about the gross returns. Everything here, all of these kind of interventions we're talking about are really just about efficiency, creating better efficiency in the fund structure to try to maximize the net return that comes out of the gross return that the manager generates through its deals.
Yeah, and I think that point of innovation around, certain strategies for reducing that gross to net drag is really important. And, it doesn't only focus on these elements where people kind of are, I suppose, sensitive around management fees and things like that, but also around costs, right? So controlling your fund costs is another essential lever that you need to be focusing on and that fund managers need to be paying attention to. I think one of the things that we've experienced in the market is that fund managers are so obsessed with the cost of their own operations. So how much, their salaries, the cost of their rent, and things like that. And very easily also, they try and push some of those costs onto the fund so that that's a fund cost. But ultimately, what happens is that if you don't control the fund costs, right, that your gross to net drag is just so significant that the net returns to investors are significantly compromised, right? And will underperform just because you were saying, well, at least it's not a fund manager cost, so I'll make it a fund cost and therefore it doesn't affect me as much. That can't be further from the truth, right? To the extent that those costs are within the fund construct, yes, it might be an immediate cash flow relief for you, but ultimately you see it in those numbers right at the end. And you need to be able to strategically manage the costs, like unavoidable costs. We acknowledge due diligence costs, setup costs, all of those are unavoidable costs, but you have to strategically manage those to minimize the impact to the ultimate net IRR, right? So what does this mean, right? What are some of the things that you can do? So certainly you can look at some of your due diligence costs, perhaps looking at whether portfolio companies as part of your funding price package or structuring of that investment can carry some of the costs. We've definitely seen managers specifically trying to streamline some of the legal processes for fund setup and really being very critical in how they procure these services and engage lawyers and spend time getting lawyers' input, and how that has resulted in possibly significant cost savings, across the board. So there are ways to do it. I think just fund managers really need to be intentional about focusing on these elements, as much the fund budget as they do the fund manager budget.
But I think, being cost efficient is one thing, and that does help with sort of narrowing the gross to net. But I think in the early stages of a fund, of a fund, especially post first close, I think it's important and really, like, we've seen the benefit of accelerating deployment and how powerful that can be as part of your strategy, and it's often overlooked, I think, in terms of first close with certain managers. Fees, we speak about benchmarks and that pension funds are looking at you on a quarterly basis. And one of the challenges you find is that because fees are calculated on committed capital rather than deployed capital, you're effectively inflating the effective fee percentage if you do it on the invested capital amount up at the early stages of the fund. I think, having a robust pipeline of investment opportunities pre-first close, enables swift deployment once that capital is secured, and ultimately will reduce the drag caused by management fees in those earlier periods.
Yeah, and I think I would just echo that point around the deployment. It's probably even bigger than all the cost factors we've been talking about. Deferring deployment, having slow deployment is probably the biggest factor that drags the net returns down. And this is something that we often see that new fund managers kind of recognize only when they're through their investment period in the second half of their first fund, and they kind of resolve to do better in their second fund and manage things better in the second fund. But we don't want to everyone to have to experience that first pancake thing of the first one doesn't really work. You want to, and that's why we're trying to highlight these issues, to try to make sure that everyone kind of knows as much as possible, and can kind of deliver the best returns from their gross returns that's possible. So I guess the final thing to consider around this area is the carry structures. And this is something where we've seen significant movements in the market over the last 5 years or so. As everyone would know, I mean, the traditional carry model includes the idea of a catch-up. So after the hurdle is reached, there was 100% catch-up to the fund manager before the 80-20 split starts. We've seen that's become much rarer these days, and we think that's a good thing. And this is in line with the guidance that comes from the ILPA 3.0 guidelines, where they actually ask for what they call a hard hurdle. So that what ILPA actually suggests is having no catch-up. In a South African context, because of smaller fund sizes and kind of smaller absolute amounts, what we're quite comfortable with is the shared catch-up model. where, you know, there's a rebalancing that happens after the hurdle is reached, where you know, managers can kind of disproportionately benefit at that point, but it's not to the full extent of the 100% catch up. And the reason why we think this is, you know, is still important to retain some catch up is often that's what leads to greater team stability and sustainability. But you know, we are very skeptical of the 100% catch up because of some of the behavior that it can incentivize, where it starts to misalign interests, and where the fund manager can still do very well out of a fund, even where the kind of the net return to investors is what they would consider disappointing. And this is where you get unhappy LPs, where the GP does well and the LP is disappointed. That's a misalignment. And this having a full catch-up model, but a kind of a low net return that's just a bit above the hurdle, that outcome is something that upsets people, and that's what lands up being no re-up, no fund two in that scenario. So yeah, we think that thinking very carefully about this, thinking about alignment, and thinking about the outcomes over a wide range of return scenarios, that's where people should be focusing.
Yeah. And I think, you know, what all three of us agree on is that everything we've said today is true, right? But what does it actually come down to in the end, right? And for those of you who have attended some of my presentations or speeches, trainings, you would know that this is a point that I constantly emphasize. And that's the fact that transparency builds trust, right? I think without that, you really are on shaky grounds. And therefore, it's something that, you know, when you are engaging with anybody for that matter, whether that is the investor engaging with the manager or the other way around, or your underlying portfolio companies, I think that it's an aspect that really cannot be undervalued. Now, for us, when we look at trust and how, you know, we build that trust, we really focus on, I suppose, three key elements, right? First being credibility, second being reliability, and third being intimacy and orientation. So first focusing on credibility, right? What does that actually mean, right? So what is the investor assessing? The investor is assessing, do you have the skills? Do you bring the credentials? And specifically, is your strategy research backed? And are you the expert within your strategy? All within the context of the circle of competency, which I referred to earlier. You really need to be able to present that you or the investee has the knowledge, you have a well-rounded strategy, and that you really are in touch with the market, right, in which you operate. And that firstly establishes credibility between you and an investor. Secondly, is reliability, right? So this speaks to your actions, right? And what the investor really wants to know that they can count on you, right? That you've done what you've promised, and ultimately they can trust you, right, with the capital, and they can do so on a fiduciary basis. So, you know, the evidence is in what you present, it's the quality of what you present, but also in how you're able to map out what you've promised from a strategy perspective, connecting the dots to what you have in your pipeline. That in itself is a form of relying that with the strategy that you're presenting to investors is actually what you will be executing against. And then thirdly, and definitely not least important, is this issue of intimacy and orientation. Once again, it's not an aspect that should be undervalued in getting to build a trust relationship, or a relationship founded on trust, right? And the focus here is specifically on this relationship. What you want is you want a perceived level of safety as the investor in the hands of the fund manager, right? Because ultimately, if I was an investor, it's either my own capital that I want to lose, or I have a fiduciary duty to my client's capital that I'm investing. And therefore, I want to know that the person that I'm investing this money with, that money will be safe there. They will do as they are told. I can trust them, right? Therefore, in these processes, what a lot of the investors then attempt to do is they try and get to know you a bit more, right? So you'll sometimes find them digging a bit deeper into some, of the more softer questions within their engagements, and they won't do that directly in an interview question, but they will find a way to see whether there's a culture fit and whether there are shared common goals between yourself and them, right? Because ultimately that, once again, builds to the foundation of trust, right? And therefore, it's very, very important when we engage with emerging fund managers or fund managers more broadly, that we really do know that they've got the broader interests at heart, right? They're not here just to get our capital and to do with it what they want. They are really here to service the kind of impact elements that sit around their strategy. They're not selfish in that regard and therefore only here for commercial gain, but they are, they're playing the longer game, and they are playing to be to an outcome that will deliver the returns towards even, our ultimate clients, to the extent that we are playing our role as fund of fund, right? And that's really like the foundation for us, right? And yes, all the technical bits matter, and certainly it's part of the journey, and it's certainly part of crafting your strategy and everything else, and all the elements that we've mentioned are important. But sometimes it just comes down to some of the simple things, and that's what ultimately matters, right? And when I say simple things, I really do mean simple things, right? Be prepared and on time. I cannot tell you how important that is. Communicate very early on, very transparently. As I said, once again, I reference the circle of confidence. Say what you don't know, but see that as a means to demonstrate that you've got processes to mitigate for what you don't know, or that you've learned lessons and therefore have refined your processes for what you don't know. Be reliable in terms of connecting the dots. Don't present a strategy for which your pipeline, for instance, does not speak to the strategy. It is tantamount to misrepresentation. So those kind of things throughout your process and throughout your pitch and your engagements during due diligence and so forth become really, really, really important. Another element is to not copy and paste, right? Be authentic. I speak from experience when I say we've seen managers copy and paste policies from their early employers in exactly the same font with exactly the same color scheme, and then presenting it as their own. That destroys some level of trust, right? We know those policies, we sit on those advisory boards, possibly ourselves, and we know that it is a copy and paste, right? And therefore, it's important, once again, to kind of build this foundation of trust, is to be authentic, right? Not only authentic in your strategy, but authentic in whatever you're presenting. The issue of innovation has also been mentioned before. I think it's important to balance innovation with benchmarking. You are, as I said, within a very crowded market. You operate within a very crowded market, and therefore research that is available to support your statements and to position your differentiation relative to this crowded market is, a fundamental part of telling a consistent story across all aspects, right, including your team. And then ultimately deliver on what you've promised, right? And this is something that, people think about. Yes, as a fund manager, I'm being measured by the investor 10 years from now in terms of whether I've delivered what I've promised. But that's actually not the case, right? You're being measured on whether, if you've told me today that you are going to send me a presentation on Friday, and that's the deadline that you've said, whether you are delivering on a promise as small as that one, right? Once again, all evidence that I can actually trust that what you do and what you say is something that you can actually deliver on, right? And what I can trust throughout this very long dated relationship that I can deliver on. And then lastly, I think that, we've mentioned it in everything that we've said today, is that pipeline development is something that really should not be neglected for all the reasons where we're talking about gross to net, about the J-curve, about deployment, about evidencing your strategy. And in the same, instance, the operations and the financial models, which we've also spoken about. But acknowledging that that's not only true for just the fund or just the manager, and that ultimately having all of that in place and making sure that that's available to be presented to any possible investor. From the perspective of the investor, they would want to see that information at both the fund manager and at the fund level. So it's a bit of a, a lot of information, and I acknowledge that, but this element, the specific kind of construct of trust and the construct of how process informs and behavior informs that, through aspects, as I said, like credibility, reliability, intimacy, and orientation, really becomes the foundation of every single conversation.
Yeah, I think that's right. And it's in building that trust is definitely a journey. And, we find, if I think about our best relationships with fund managers, it's those who've let us in, and who, you can work with day in, day out, and they can deliver on that trust. Yeah, so all of these things that we talk about, the transparency, the diversification, a strong team, and all of these elements that we've been discussing this morning, this is what actually turns, what we see, and what fund managers produce as initially a PowerPoint slide deck, that kind of creates it into something that's real, tangible fund that can actually succeed.
Yeah, I couldn't agree more with what you both have said. Okay, it's about finding that balance. It's about keeping it simple, removing some of that complexity at the early stages. It's about staying focused on the bigger picture. Ultimately, fundraising is about belief. It's about being patient, having and knowing that it does take time, specifically in our market. But yeah, you have to have a belief that your fundraising will be successful.
Yeah, that's right. Okay, so I'm sure that every one of you who have answered the polls are eager to see what the results are, and we're going to go through them one by one, the 4 polls. Michaela, if I can ask you to put up the first one. We haven't seen the results, so we're also interested to see the results. Okay, so this question was, which of the challenges do you find most pressing for emerging fund managers? And sort of the clear winner here is building a credible track record. And I think that makes a lot of sense. For new teams to demonstrate the track record, even if they're taking their track record from their previous institutions, it's sometimes a bit challenging to kind of demonstrate enough deals or enough involvement or being the lead or what you did versus what other people did. That can be challenging. So that's not unexpected. And we also talked about this idea of managing costs prior to first close and the working capital requirements, and this, I think, it speaks to the way we put together the Fund Her Forward program, which focuses a lot on providing working capital to fund managers to allow them to manage that period and actually get their team in place and incur some costs ahead of the first close. Any other comments, guys, or shall we go on to the next?
Yeah, I just wanted to say another thing, right? Is that I think one of the things that we've experienced around the warehousing, and maybe it's a reflecting on the market more than the question, is that when you actually have some warehousing capital available to allocate, the fund managers in the market don't seem to be many that have developed deals far along enough to justify a warehousing allocation. And I think that's something that both investors providing those solutions as well as the fund managers seeking those solutions or something, warrants a bit of reflection. So, having an idea of wanting to pursue a possible company, or investment into a company, but you're still going to structure that position over the next year, or you're not advanced yet in those discussions, and then already seeking kind of, formalized warehousing from an investor that needs to hold on to that allocation for a period of time before they themselves can then actually pay a way into that allocation. 12 months only from now, I think is a timing mismatch, right? So a lot of the warehousing solutions out there are really to fund very real deals that are executable within a very short period of time, for which the fund manager has already advanced conversations. So we get approached often with deals that I would say are underbanked for the solution that is warehousing, and therefore I think that there needs to be some, as I said, reflection from both ends to make sure that, to the extent that that is available in the market, in order for you to make use of it, in order to build and demonstrate credible track record, the deals actually need to be real deals that are fundable, right?
Yeah, I think Made, I would agree with you. I think it was interesting to observe, I guess, the interest that we received on the Fund Forward program for warehousing, and it speaks to, I guess, some of the I guess the applicants that we reviewed as well, and the information that they shared in terms of their pipelines and where they were. In that, a lot of that was not near term, not immediate, but more a demonstration of, I guess, potential deals that sort of focused on, that were closely aligned or aligned to their strategies, but not necessarily something that they could execute on immediately. But that is, I think, also a key area that I think emerging managers and for that matter, mature managers need to focus on when looking at pipeline, is actually focusing on those that are going to be ones that can actually be executed on, either through a warehousing structure like something that we have provided to the market, or that can be executed on pretty soon after calling a first close for that particular fund.
Okay, Mikkel, let's go on to the next poll. All right, so here we were asking, what aspect of fund management do you believe investors prioritize most when evaluating emerging fund managers? Okay, so here the winner is an experienced team with track record. So it's really the same points coming out of the previous poll, where we said track record is kind of the most difficult thing to demonstrate, and here the view of the respondents is that is the thing that investors rely on the most. Kind of underlining this, the response in the previous poll. Yeah, I guess also interesting to see, the points around effective risk management and portfolio diversification. I think that talks to some of the points we made earlier around sort of the ability to build a portfolio in a diversified way around a strategy, honing the strategy in the right way that it produces enough opportunities that sort of individual investment risks can be mitigated through the kind of the construction of the whole portfolio. Chad, Made?
I'll let Made go first.
Yeah, go ladies first. I think that it's an interesting, obviously, question and answer set, and once again, as Rory said, focused on this ability to demonstrate track record, which I think is really, really true, right? But I think what is worth acknowledging is that the reality of the market is that the investor priority relative to their engagement with a fund manager changes as the relationship progresses, right? So yes, initially for them, it's a mandate fit question, right? So I would think that things like, are you investing in a mandate that aligns with what we are looking at, in terms of if there's any specific impact focus that an investor has. So for instance, job creation, which is a focus that we have in our BBGF fund because of our partnership with the Jobs Fund. So you do a bit of a mandate fit, right? And within that mandate fit is this issue of effective risk management through portfolio diversification is what becomes part of that strategy, right? And mandate fit consideration. So I think that is almost an early on consideration, because the investor upfront is asking, firstly, can I actually look at this deal or portfolio or strategy a bit more because it fits my mandate? Then the next bit, definitely, I think, there's obviously a strong awareness of the team and what the strategy actually looks like, the differentiation and so forth. But then once they've kind of convinced themselves that the team works, right, Then the next bit of priority is that, well, can this team actually execute the strategy? And that then includes a lot of the operational and financial management ability or capabilities, right? So I think that all of these, I suppose, are equally important, but they are important at different times of the process. And what you need to acknowledge when you are the one fundraising is that first, clear the mandate barrier with an investor, whilst always impressing on them that you are the best to execute the strategy and that you are differentiated versus the market. But understand equally that when it comes down to it, that you're going to have to demonstrate your operational and financial management capabilities very soon after that, and not in any way discounted to their consideration of any of the other two aspects.
Yeah, I think it was interesting to see that. I guess track records obviously is important. I think I'll go back to what we spoke about earlier in terms of where an emerge, especially for emerging managers, where you don't have that that track record as a team, but individually may do. I think it's important that comes through in your storytelling. I think it's important that you have reference cases or case studies that you can sort of articulate and demonstrate speaks to your strategy, and also that there's, I guess, it can be independently verified with whoever has worked on that in the past with you. I think it's a critical, it's a way of actually demonstrating that track record and speaking to it more authentically when meeting with institutional investors and their consultants. It's interesting to see that, I guess, transparent communication and trust building efforts is seen quite low here. Again, it's maybe at the stage of discussions, Made, but I think over time you'd expect that to be significantly higher by the time you get to a first close, right? And for that to be maintained and continue over the life of the fund. It's so important, and it really does determine not just only the success of your first fund, but also where potentially you may land in terms of raising a second fund or a third fund for that matter. And in terms of with your existing LPs, and also what they actually have to say in terms to the broader market when you're raising that next fund. Enhanced commercial terms, nobody said anything there. That's an interesting one. I do think there is a lot more work that could be done around enhanced commercial terms, not just for investors, but also to actually create better alignment in the market for private equity. I've got my own views there, which I think it's very hard to get people to change, not just managers, but also investors. I think people don't like change typically, and don't necessarily see the benefit of making some changes to things. But I do think there's a way still to go, specifically in the South African landscape, around improved commercial terms to encourage more investment from institutional investors into this space.
Let's go on to poll number 3. All right, so when structuring a fund, what approach should fund managers follow to balance that simplicity with meeting diverse investor demands? Okay, so we've got a mixed bag of responses here, fairly even numbers, across the different responses. I guess what comes just ahead is that bottom one, so prioritizing thematic alignment and specialization and add complexity if needed. But I suppose that the answers here, Chad and Made, I mean, they demonstrate that this is not, an easy one to. It's not actually an easy one to say that there's a specific rule for. When you and it's something that fund managers actually have to make a judgment call on. How much do I cater to the individual needs of that specific investor versus how much do I try to maintain sort of a standard approach. It's I mean, we definitely see results in the market of different approaches here. I think our advice would be around this is to talk to investors, to take them into your confidence a bit and talk about kind of the trade-offs that their requirements actually cause. Because there's a consequence to everything. There's a consequence to adding more complexity, sort of different sets of reporting, as an example. There's a consequence to creating more legal carve-outs, which can create administrative challenges. There are consequences, but I think the only way you as as a manager can understand kind of more where the red lines are, versus what LPs are asking as nice to haves, is by talking to them and you know, and being real and genuine in that engagement. Yeah, so I guess in the absence of kind of a very clear way ahead, this is the kind of nuance that managers need to implement.
Yeah. Sorry, Madam, I'm going to jump in.
Yeah, sure.
Apologies.
No.
It's just an interesting observation, I guess, to see it's pretty close in terms of the answers and responses there, and I think part of that is investors are to blame, right? To an extent, around what the manager actually does. But again, this speaks to, and by investors, I mean you've got the DFIs, you've got the local pension funds, you've got government for that matter potentially as well, and sort of other alternative investors, whether it's life insurance companies, banks, all with their own sort of, I guess, requirements and demands. But ultimately, at the end of the day, what it comes down to, in my mind, for a manager, is to decide what they think is authentic and is what they want to be, what they believe in terms of their fund strategy and what they want to achieve. It's for them to then understand that potentially, if they take the simple route, that potentially means that certain investors are not investors you should be talking to, and are unlikely to look at your fund and actually allocate to you. And that means that from a fundraising strategy, those are investors that you exclude from this particular fund at this stage. You know, that's for, I guess, a manager to consider, and for them to really then, you know, stay there. I mean, stay true to, and know that potentially means that you've excluded a certain amount of investors from your potential investor base at the end of the day.
Yeah, one of the things that I was going to add is that I think it's the one thing I would caution against, right, and that we see specifically looking at emerging managers is that emerging managers go out with a strategy and they really map their investor base, right? And when they map their investor base, they say they're going to be approaching international DFIs, right? And they need a Mauritius structure to aggregate their capital through. And then we're going to go with local pension funds, let's say in the South African context, and therefore they need to have a parallel South African structure. And then also they're looking at the international other pension funds outside of the DFIs. And therefore, for those dollar commitments, they're wanting to set up something in, I don't know, Delaware, right? And what we see then happen is that a manager that should be completely focused on, you know, running their operations effectively as lean as possible, right, are incurring a significant amount of cost to already create these very complex structures that result in parallel investment vehicles, right, that therefore determine the structure of their fund, right, in advance of actually even sometimes having some of the conversations with those investors, right? And I think that that's one of the things that I think we always want to caution around. You coming up with the structure and saying, you know, once the commitments flow, I will incorporate this vehicle in this jurisdiction. Apart from the licensing in those jurisdictions, which becomes an important thing to kind of, you know, have in place before, you actually don't have to really set it up yet, right? Like the partnership doesn't have to exist before you speak to the investors in the idea of that partnership. The construct is agreed, and with the subscriptions of all these investors, it's effectively put into force, right? So I think that's what I would caution around. Like we've seen a lot of investors, in the instance, or a lot of fund managers thinking they're going to get dollar investments, and therefore creating these very elaborate, very costly aggregating structures in advance of having a single cent committed to the fund, right? And therefore, the complexity might be relevant if I'm getting somebody that wants to invest $100 million. Yes, it justifies the complexity and possibly creating a structure that supports the aggregating of their capital. But in the absence of them actually being there, having signed up, having committed to that fact, right, there's no need for me to preemptively necessarily do that. And that's the fine balance, I would say, when, you know, considering the structuring of your fund, considering the complexity that you introduce. There is a bit of a cost benefit effort versus timing effort, equation that you have to balance. And it's difficult, I understand that, but don't think that you have to have everything done and dusted from a kind of legal and fund setup perspective in advance of actually getting a commitment from LPs.
Okay, we've got a last poll, and then we've got some questions that have been coming through in the Q&A, which we'll get to. So we'll just spend a few minutes now on this last poll, Mikkel. Okay, so this one is around what aspect of capital raising or management in private markets causes you the most frustration or concern? All right, so I guess the number one here, but again, there's no real clear winner, but number one would be the high operational costs and managing that cash burn during the early fundraising stages. So it's that issue of, for emerging fund managers, how do you bridge that gap from deciding you want to start a fund to actually getting into full operation and actually fund all of that? And again, going to the, why it is so critical to have working capital facilities as part of the Fund Forward program. But also quite, significant numbers coming through in having limited access to diverse pools of capital, especially from international investors. And I think this is true. I mean, as South African fund managers, or African fund managers in general, it's expensive to target international investors, and can be the timelines can be extremely long. Even if you get encouraging responses quite early, so that can be very expensive to manage those processes. Yeah, and I think that point that we have up at the top there as well, with aligning the investor expectations and demands, it's very similar again to what came through earlier, and what Chad and Made were just speaking to, which is it's balancing those expectations and that cost benefit analysis that we were just talking to. So Made or Chad, any further comments on this one before we go to the Q&A?
Nothing from my side, Rory.
Yeah, I think that when fund managers are kind of going through this fundraising process and capital raising process, right? I think the expectation is always that there's some level of frustration, at whatever point of the process. I've heard many saying that, beyond what is mentioned here, the fact that they have to complete the same due diligence questionnaire with slightly different questions, and have to effectively reframe an answer that they've given to the one investor in a slightly different way because the question is slightly different, is really one of the things that results in them not being able to focus as much energy on crafting their investment pipeline, and therefore because they're stuck in these very extensive due diligence processes. So there's been some, I suppose, pushback and concern raised on some of those elements, and what can be done by investors to, I suppose, streamline those processes more. I think the mandates, though, are so nuanced that I think that from an expectation perspective, probably that won't change in the short term. Although I think that would be a good outcome ultimately, to the extent that there can be some conversions of admin process around fundraising. That speaks to just one of the elements here, that is the high operational cost, right, and managing that cash burn during the fundraising stages. So I can appreciate that that's top of mind, and I can appreciate that that's driven by these type of nuances where we need to be, I suppose, more efficient from both the investor and fund manager perspective in order to manage that well and better.
Okay, great. Thank you. We've got a few questions that have been coming through on the Q&A, and I'm just going to direct these where I think they're best landed. So, Made, I'm going to ask you the first one, which is, so the question is, what advice would you give to an emerging fund manager who's just starting to develop a team, and how do you decide which roles are essential from the beginning? So this is to that point that we've just been discussing around managing that early stage and managing costs.
Yeah, I think a lot is being asked of a fund manager in, I suppose, especially an emerging fund manager with no income base, management fee income base from a prior fund, right off the bat, right? But I would say that the focus is firstly to direct, I suppose, the efforts into making sure that whoever you have in whatever role, you can properly convince an investor that you can source deals and execute those deals in anticipation even of a first close. So therefore investment skills and individuals, which should be effectively the key people raising the fund to begin with. But also making sure that there is some operational and compliance support in dealing with, as I said, investor relations, communications, fundraising, call it what you will, coordinating that. And what we've seen, though, is that because you've got this massive constraint on working capital, the reality for an emerging fund manager is that the investment professionals, the founders, the fund managers, the partners actually raising the fund take on all of that responsibility from day one. And I think that's all good and well. I think what managers are missing is the fact that even within that construct where that specific individual and partner is prioritizing both investments and let's call it operational and compliance issues with investor relations, that there needs to be some level of not delegation but split of accountability, right? So what we found works is that if one partner takes on one responsibility, the other partner doesn't duplicate efforts, right? They support the partner A, and partner B has accountability for something completely different. And then you make use of outsourced, insourced kind of model where you can always get some part-time support from, whether that's running your accounting systems and actually just accounting for the cost that you are incurring, or other aspects of your processes, maybe ESG initially, getting a consultant in to specifically be procured on an investment by investment basis to make sure that, because you don't have that capacity internally. I think that's where you then start looking at a cost benefit model before you even start considering growing the team, because you want to keep that as lean as possible prior to actually having that confirmed management fees off a first close.
Thanks, Made. Chad, I'm going to go to you for the next question, which talks to a lot of the discussion that we had today was around all of these little tweaks that can be done to the commercial terms and all of that that structuring. And the question is that does changing these commercial terms, does it actually result in more momentum in fundraising?
Yeah, Rory, I think, from my experience and seeing managers that have succeeded in getting to a first close and raising funds, raising their sort of targeted fund size, I think it does have an impact on, or create some momentum for you, especially in those earlier stages. I think if it speaks and it's aligned to your strategy and you are transparent around why you've structured it that way, and it ensures sustainability, it's definitely one way to look at it. I don't think every manager can, but I think it's lower, like what I think has done really well in the market, and has resulted in earlier sort of closes and reaching those targeted fund sizes, is where your management fees on committed capital are potentially lower, or have a step change on them, or where they are up to a certain percentage of committed capital, but at the discretion of those managers to draw down, and it's tied to, it allows and it's tied to something around transactions or related fees aligned to deployment. Higher hurdles have also been something that have sort of encouraged more investment, I think, into the space, with or without catch up, or with shared catch up for that matter. The step-free structure tied to resource deployment is also another way to look at it. I know there's a fine line that you need to manage there in terms of not doing deals for the sake of deals. But it's, again, that's where the manager needs to consider how it manages for that risk, how aligned it is on the carry side as well, to sort of mitigate for deploying for the sake of getting fees at the end of the day. I definitely think it has sort of in my experience, in terms of some of the managers we've looked at, encouraged or improved the momentum to get to that first close.
Thanks, Chad. I'm going to try to answer a few questions in one, because we've had questions around whether consultants are advising their clients correctly when it comes to the J-curve and gross and net IRR and all of these aspects, the reputation of private markets, and whether investors should go through all of the stress of investing in private equity. And what are the kind of the main concerns that investors have? So I'll just have a go at answering some of that. So I think for those institutional investors who haven't invested in private equity before, I think the two main considerations that come up before they invest is liquidity and fee levels. So on liquidity, I mean, this has been particularly topical because of the two-pot situation and the liquidity demands that it's put on retirement funds. Over the course of this year, it's been a big consideration over the last couple of years leading up to two-pot, and I think a lot of decisions have actually been delayed from an institutional side while they figure out their liquidity position. So liquidity is number one. It's something that pension funds are not used to, having locked up investments if they don't invest normally in this asset class. And then if you think about the 2% fee, that's in relation to every other asset class that they invest in, which has got a fee at a fraction of 1%. And depending on what mandate it is, how active or passive it is, it's at varying levels, but it's all far away from the level of private equity fees. So the fee is something that it's a big issue. But I think post the investment, actually, what comes as a surprise, and this goes to the question that we had around our consultants advising their clients around J-curve and net IRR and all of that. I think the surprise is how long it takes kind of for performance to come through at a net level in a lot of funds. And this is a lot of what's behind the comments that we've made throughout the course of the morning, and how managers can actually improve this experience, because this is the way that the asset class actually gets institutionalized and becomes a repeatable thing for institutional investors. Because the frustrations around slow deployment and the effect that has on the J-curve and how it deepens the J-curve, and the various other kind of costs and things that creep in, those are the kind of frustrations that subsequent to investing comes in. I think for those institutional investors who then go and kind of continue and actually build a program and then have allocations that are in different vintages, or they take a fund of funds approach and can actually start to balance things out, this becomes a lot of these issues go away as long as the selection of the funds is good and they can start to deliver a lot more consistently. But I think that those first few years are often quite difficult, and there's often a lot of questions around, are we doing the right thing? But I think for those more seasoned institutional investors in the space, they know that as long as the selection is good, the returns do come through. But they've just got to sometimes endure a bit of a difficult period ahead of that. I think that's all we actually have time for. There are a couple more questions, but please do get in touch with us afterwards. We've just run out of time. I'm just going to hand over to Made to close. Thank you, everyone.
Yeah, I think this has been a really nice discussion to have with my colleagues today, and I hope that you find it equally interesting. But as we conclude, I wanted to just kind of remind you all that the reason why we've called our thought leadership piece all the pieces matter is exactly because that is the fact, right? That is the reality of private equity everywhere in the world, right? All the pieces matter. And we in a world where investors seek fund managers who understand their needs and demonstrate a commitment to building a diverse and resilient portfolio, operate with transparency, as we've mentioned, the accuracy of the financial models, articulate a clear vision, all these elements kind of present the whole, right? And therefore, as we try and kind of feed back to the market and in our efforts of market building, we've mentioned all the pieces matter papers that we've published. We appeal to you to go and access them. if you've got any questions on the content of those, please do reach out to us. We really would welcome to engage with you if you've got any more questions, as Rory has said. And then, before we sign off today, I think lastly, my request to you would be to kindly make some suggestions on topics that you would like for us to consider for inclusion in this All the Pieces Matter work that we do. We really want to be, I suppose, posing market relevant or publishing market relevant pieces that respond to kind of the questions and interesting topics that I think needs to be explored more as all of us really work towards, growing private markets and growing private markets in Africa to the same level as what is experienced in developed markets. So with that being said, you have a great balance of the day and what's left of the year. Really do appreciate you having taken the time today to join us on this webinar. Thank you very much.
Thank you, everyone.
Thanks.